Bismillahirrahmanirrahim. In the previous class, we were discussing about the gap and IFRS. Now, here are some basic accounting principles and guidelines. I told you 10 accounting principles and guidelines. The first one, it is economic entity assumption. Now, what is economic entity assumption? Accountant keeps all of the business transaction of a sole proprietorship separate from business owners' personal transactions. Now, keep in mind, if there is a business, suppose I start a factory, any factory. Who is the owner? Suppose A is the owner. Now, if you will look at this from the point of view of the law, in the eyes of law, these two, factory and owner, A, me, we are same. These two are same because this business, this factory is my factory. So in the eyes of law, we are the same. But in the eyes of accounting, this is separate person and this factory is separate person. This is called business entity concept. Now, what does it mean? The transactions of factory and the personal transactions of the owner, these are separate. I'm telling you, the transactions of factory and the personal transactions of owner, these are separate. You will not mix these. Suppose you are purchasing a machine, so you will record it in the factory. You are purchasing a land, record it in the factory. You are purchasing furniture, you will record it here in the business. If you are purchasing any other thing, cash of the factory, it will belong to the business. But if you are purchasing, this owner is purchasing a personal land, you will not record it in the business. If he is purchasing a personal building for his personal use, you will not record it in the business. If he has cash in his personal account, you will not record it in the business. If he is purchasing a car, so you will not write it here in the business because this is his personal car. So you will not mix the transactions of business and the transactions of owner. You will record it separately. This is called business entity assumption, that don't mix the transactions of owner and the transactions of business, because these are not same. These are two separate persons. These are two separate entities. Owner is separate and business is separate. So you will not mix the transactions, personal transactions of owner with the transactions of the business. If you will mix it, it will be difficult for you to get the actual results of the business. If you are purchasing building and you are recording it here in factory, if you are purchasing land and car and you are recording it here in the business, so it will be difficult to measure the profitability. So don't mix the transactions of owners with the transactions of the business. For legal purposes, a sole proprietorship and its owner are considered to be one entity. I told you, in the eyes of law, these two are same. But in the eyes of accounting, these two are separate. But for accounting purposes, they are considered to be two separate entities. This is called economic entity assumption. So, owner is separate, business is separate in the eyes of accounting. This concept is called economic entity assumption, and you will not mix the transactions of the business with the personal transactions of the owner. The second standard is monetary unit assumption. Now, what is monetary unit assumption? Economic activity is measured in US dollars. Now, US dollar is not must, it can be any currency. All economic activities must be measured in a specific currency. You will use a currency. You will use a standard in which the value of all transactions can be measured. And only transactions that can be expressed in US dollars are recorded. And keep in mind, you will record only those transactions whose value can be measured in terms of money. Basically, this assumption, there will be a unit of measurement, and that unit of measurement is basically currency. If you are purchasing something, suppose you're hungry and you want to eat something, so you will pay in terms of money, Afghanis. If you want to go to some other country, so you will purchase an online ticket, and again it will be in terms of money. So it is assumed in this standard that all those transactions which can be measured in terms of money will be part of accounting record. Those things whose value cannot be measured in terms of money, we will not include it in the accounting record. Now, what is he saying? Because of this basic accounting principle, it is assumed that the dollar's purchasing power has not changed over time. And you will use that currency which is stable. As a result, accountants ignore the effect of inflation on recorded amounts. For example, dollar from 1960s transactions are combined with the dollars from 2015 transactions. So don't confuse yourself here. All those tangible and intangible assets whose value can be expressed in terms of money, only those transactions will be recorded in accounting. Those things whose value cannot be measured, we will not make those events or transaction as part of accounting. Like if you know that management is very important asset for the business, but we are not recording it in our balance sheet. So this is basically the reasons. Those things whose value can be expressed in terms of money, only those transactions will be part of our accounting system. So monetary unit assumptions, according to this assumption, only those transactions whose value can be expressed in terms of money will be part of our accounting system, accounting information. Take another example. Suppose if a person comes to your company and he gives a lecture, very good lecture on motivation and different other concepts. So it is also a transaction. But since we cannot express this transaction in terms of money, so it will not be part of our accounting. So monetary unit assumption means that all those events which can be expressed in terms of money, that is, we can quantify it, we can express it in terms of money, will be recorded. Those transactions which cannot be recorded in terms of money, we will not make it part of our accounting system. The third principle, it is time period assumption. This accounting principle assumes that it is possible to report the complex and ongoing activities of a business in relatively short, distinct time intervals, such as the 5 months ended May 31st, 2015, or the 5 weeks ended May 1, 2015. Means there must be a time period for the continuous activities. Like 5 months, like balance sheet for 5 months, income statement for 5 months, but mostly we are using what? 1 month time period. We are using 3 months as a time period. We are using 6 months as a time period, or we are using 1 year as a time period. Accounting activities are ongoing. Accounting events are ongoing events, continuous events. But for all these events, it is must that we will specify a time period so we can easily measure the performance of the company. Like he's saying 5 weeks ended May 1, 2015. The shorter the time interval, the more likely the need for the accountant to estimate amounts relevant to that period. For example, the property tax bill is received on December 15 of each year. On the income statement for the year ended December 31, 2014, the amount is known. But for the income statement for the 3 months ended March 31, 2015, the amount was not known and an estimate had to be used. Simply don't confuse yourself. You will specify a time period for the measurement of your accounting. And I told you we are using what? We are using 1 month time period, or we are using 3 months time period, or we are using 6 months time period, or we are using 1 year time period. These are the standards which are used. It is imperative that the time interval or period of time be shown in the heading of each income statement. Statement of stockholders' equity, statement of cash flow, and balance sheet. Labeling one of these financial statements with December 31st is not good enough. It is not must that there must be one heading that December 31st, 2001 and December 31st, 2002, 2003, 2018, 2019 is not good enough. The reader needs to know if the statement covers the 1 week ended December 31st, 2015, the month ended December 31, 2015, the 3 months ended December 31, 2015, or the year ended December 31st, 2015. So it will be easy for the reader that this statement is monthly statement, this month statement is quarterly statement, or this statement is half yearly, or this statement is yearly statement. And then if you are measuring all your performance according to a time period, then you can also make estimates about the future. So time period assumption, according to this assumption, there must be a specific time period for your ongoing activities. And that time period must be either 1 month, 3 months, 6 months, or 1 year. This is called time period assumption, that there must be a specific time period for measuring the performance of the company. The next principle, it is called cost principle. From an accountant's point of view, the term cost refers to the amount spent, cash or the cash equivalents, when an item was originally obtained. Whether that purchase happened last year or 30 years ago. Cost means there are two concepts in accounting. One is called cost, one is called expense. Cost is the amount spent for the money spent for purchase of an item or making an item. The money spent on making a mobile, or the money spent on making a computer, or money spent on making a building. So that is basically cost. Like if I'm going to purchase a pen for 10 Afghanis, it is my cost. Now, what is expense? Expense is basically used portion of cost. Writing shortly, used portion of cost. is called expense. Now when you purchased a pen for 10 Afghanis, it is your cost. But when you used that pen, after 4 or 5 days, the ink is finished. Now this 10 Afghanis, it will be converted to expense. Take an example of a building. You purchased a building. It is your cost for 1 million. It is your cost. But when you use the building, its value is coming down. We call it depreciation. So depreciation is basically the expense. When you purchase stationery, you know about stationery. Suppose you purchase stationery for 10,000 Afghanis. That is your cost. Suppose after 2 months or after 1 month, the stationery whose value was 2,000, it is used. So now that portion which is used, it will be an expense. So here in cost principle, we are talking about cost. According to this principle, suppose you purchased a piece of land in 1999 and you purchased it, suppose, for 5 lakh Afghanis. Now in 2019, still you are using this piece of land. In 1999, in your balance sheet, you record it land is equal to 5 lakh. In 2019, the same piece of land, its today's value, it is 2 million. You know, the market value of land, it is changing. But you will record it at 5 lakh. You will not record it at 2 million. This is basically called cost principle. Assets will be recorded in the balance sheet at their original cost, not at the market value. Market value is 2 million, but still we are recording it at 5 lakh. This is called basically the cost principle. From an accountant's point of view, the term cost refers to the amount spent when an item was originally obtained, whether that purchase happened last year or 30 years ago. We purchased land in 2019, or you purchased that land yesterday. You will record it at the original cost at which you purchased it. For this reason, the amounts shown on financial statements are referred to as historical cost amounts. I told you, you purchased the piece of land in 1999. Its value was 5 lakh Afghanis. But now today, its value is 2 million Afghanis. But you will not record it at 2 million. You will record it at 5 lakh. That's why in financial statements, all the amounts shown on financial statement are referred to as historical cost. Because in financial statement, in balance sheet, we will record it at 5 lakh, not at 2 million. That's why we call it that all amounts in financial statements, these are at historical cost. Because of this accounting principle, asset amounts are not adjusted upward for inflation. If the value is going up, you will not record it at that inflated value. Means if its value is going up, you will not record it at that value. In fact, a general rule, assets amount are not adjusted to reflect any type of increase in value. Means if there is any increase in the value of asset, you will not look towards that thing, you will not adjust that thing. Hence, an asset amount does not reflect the amount of money a company would receive if it were to sell the asset at today's market value. The main thing is because you're using this asset in your business. If this piece of land is for selling purpose, then it is fine, then you will record it at 2 million. Suppose you sold that asset. So what will be the entry? Cash will be debit at 2 million. And sales from the piece of land 2 million, or simply land 2 million. But since you are using it in your business, so you will not record it at 2 million, you will record it at 5 lakh. But when you sell it, then at that time you will realize the profit. If you want to know the current value of companies' long-term assets, you will not get this information from a company's financial statements. You need to look elsewhere, perhaps to a third-party appraiser. But he is talking about this thing that if you want to sell that asset, suppose there are stocks, shares. Share is also an asset. Now you will record it at cost at which you purchase it. But if you are dealing in shares, then at that time, what will you do? You will record when you sell it, then at that time you will record it at the selling price. But until it is in your balance sheet, you will not record it at the inflated value. So assets will be recorded at historical cost. Yes, this is the simple concept. Suppose you purchase a building for 3 million in 1999. So in 2019, building, since you are using this building, this is not for sale, so you will record it at 3 million. This is called historical cost concept. I think for today it is enough. Inshallah, in the next class, then we will talk about the other principle. Have a good time.